Is NetApp a buy or a sell? Let's get started with the model. This is a large cap company, 24 billion market cap. They're trading at 117 a share, and they have 204 million shares outstanding. This company provides a wide range of storage-related products and services. It was incorporated in 1992, headquartered in San Jose, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have positive free cash flow each year, $1 billion in 2022. It did go down 12% to $868 million in 2023. Up 76% to $1.5 billion in 2024. They did complete their 2024 fiscal year. But it did go down in the trailing 12 months to $1.4 billion. Really good margins. In 2024, they converted 24% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also positive each year. Pretty consistent, around 1 to 1.2 billion. Their margins in the trailing 12 months are 18%. Revenue is a sales for the company. That's pretty much flat. It was $6.3 billion in 2022, now it's $6.5 billion. They do pay a dividend of 1.6%, and they could easily cover that dividend. They cover it 3.5 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value of all cash flows past year 4, that's $39 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $34 billion. We divide that by 204 million shares. And we get a calculated stock price of $165. They're trading at $117, so they're trading at a 29% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 33 companies in the same industry as NetApp, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $168 million in CapEx, which is less than the average. Dell spends the most, $2.6 billion. It looks like they have the worst debt-to-equity ratio. For every dollar of equity, $2.20 of debt. So they are a bit leveraged. Their dividends equal to the median at 1.6%. HP is number 1 at 4.3%. They generate a lot of free cash flow, $1.4 billion, double the average. They rank 4th in market cap, a bit behind HP, really far behind Dell and Arista. They're trading at 27 times book value. Price to book is stock price over book value per share. They're trading at 21 times earnings, which is pretty close to the median. They're trading at 17 times free cash flow, which is better than the median. And they're trading at 4 times revenue, a little worse than the median. They generate $6.5 billion of revenue, which is a lot less than Western Digital, also less than Seagate, and those two companies are smaller in market cap. Their revenue is not growing much. Their 5-year annual revenue growth rate is 2%, which is higher than the median. It looks like this industry isn't growing that much. Nano Dimension is growing the most at 53%. They're trading 14% below their 52-week high, 37% above its 52-week low. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be pretty happy at $38,000 today, a 14% annual return. To summarize, I have them trading at a 29% discount, ranking 7 out of 10. I do think it's a really good company. I would definitely buy it short term 7 out of 10, long term 8 out of 10. Ratios aren't so great, 5 out of 10. Price to free cash flow looks good, but their other ratios are worse than the median. Financials are 4 out of 10 because their revenue is flat. Free cash flow looks pretty good, up 40% since 2022, but I'm a little concerned why the revenue isn't going up. Let's look at their income statement. Here's the 3 months ending 10/27/2023, the 3 months ending 10/25/2024. Revenue is up from $1.6 billion to $1.7 billion. Product revenue is up, and so is service revenue. Let's see if they give a different breakdown of the revenue. Of the $1.7 billion of revenue, $1.5 billion is hybrid cloud, $168 million public cloud. Here's a breakdown of the revenue by country. $860 million US, Canada, and Latin America. $540 million EMEA, $250 million APAC. And it's up in each segment. It's not up that much in EMEA and APAC. It's up a decent amount in the Americas. So their revenue is up 6% when you compare this quarter in 2024 to the same quarter in 2023. They talk about it down here. The increase was mainly from product revenue and to a lesser extent an increase in service revenue. For the quarter, product revenue is up 9%. Product revenues are derived through the sale of our hybrid cloud solutions and consist of sales of configured all-flash array systems, as well as hybrid systems, which are bundled hardware and software products, as well as add-on flash, disk, and hybrid storage, and related OS operating system, storage grid OEM products, NetApp HCI, and add-on optional software. Service revenue is up 4% for the quarter. Most of the revenue is support. That's up only 2%. Professional services is up 10%. It was $79 million, now it's $87 million. Public cloud is up 9%. Hybrid cloud services revenues are derived from the sale of support, which includes both hardware and software support contracts, and professional and other services, which include customer education and training. Public cloud revenues are derived from the sale of public cloud offerings delivered primarily as a service, which include cloud storage and cloud ops services. Public cloud revenue increased due to higher customer demand driven by NetApp's diversified cloud offerings and an overall growth in the cloud market. Let's go back to the income statement. Cost of revenue, $480 million. Cost of product, $307 million. In order to generate the $768 million, it cost them $307 million. In order to generate the $900 million of service revenue, it cost them $174 million. The margins for service revenue are much higher, as would be expected. So their gross profit is revenue minus cost of revenue, $1.2 billion. Last year was $1.1 billion. Their gross margin is 71%. The way you calculate gross margin is gross profit over revenue. Below gross profit is their operating expenses, $485 million sales and marketing, and that's up 5% from last year. Last year was $461 million. Sales and marketing is mainly payroll. It's compensation costs, commissions, also outside services, facilities and IT support costs, advertising and marketing promotional expense, and travel and entertainment expenses. Their R&D for the quarter is down. It's $257 million, down 2%. R&D is compensation costs, facilities and IT support costs, depreciation, equipment and software related costs, prototypes, non-recurring engineering charges, and other outside service costs. The decrease in R&D was due to lower compensation costs, driven by lower incentive compensation expense, partially offset by higher expenses in other components of compensation costs. Then you have G&A, $77 million, that's up 3%. G&A consists of compensation costs, professional corporate legal fees, outside services, and facilities and IT support costs. The next operating expense is restructuring. That's $12 million. In the first 6 months of 2025, management approved restructuring plans to redirect resources to highest return activities and reduce costs. That included a reduction of their global workforce by approximately 2%, so they laid off people. The expenses were employee severance related costs, and they had $1 million of acquisition related expenses. They don't give much detail on that. Other income and expenses, interest income $27 million, that's the interest they receive on their investments. $15 million of interest expense, that's the interest they pay on their debt. Income taxes are $61 million, that's down 26%. So let's go back to the income statement. Their operating income is $345 million, up from $300 million. Their net income is $299 million, up from $233 million. And they did decrease their shares outstanding. Last year, 208 million, now it's 204 million. So their earnings per share is $1.47. Last year, $1.12. Let's look at the balance sheet. Current assets, $4 billion. Current liabilities, $4.3 billion. So their current ratio is below 1. Current ratio is current assets over current liabilities. So they may need to add debt to get through the next 12 months. They have $1.5 billion of cash. Here's a breakdown of the $1.5 billion. $757 million of cash, $700 million of money market funds, and $14 million of CDs. Below cash is short-term investments, $744 million. That $744 million is treasury and government debt securities. Accounts receivables, $870 million. This is how much money is owed to them when they sell products on credit. They have $317 million of inventory. Here's a breakdown of the inventory, $229 million of purchased components, and $88 million of finished goods. Other current assets, $527 million. They have $600 million of PP&E. Here's a breakdown of the PP&E. It's $2.1 billion minus $1.5 billion of depreciation. The most PP&E is computer, production, engineering, and other equipment, $1.1 billion. $370 million of building and improvements, and $349 million of computer software. $369 million of that PP&E is in the U.S., $224 million outside the U.S. Their biggest asset is goodwill, $2.8 billion. Goodwill is the premium you pay when you acquire another company. Here's a breakdown of the goodwill. $1.7 billion is acquisitions from hybrid cloud. $1 billion is acquisitions from public cloud. They have $96 million of purchased intangible assets. Here's a breakdown of the $96 million. $54 million developed technology, $41 million of customer contracts, and $1 million of other. They have the gross value minus the amortized value. That's how you get the net assets. And other non-current assets, $1.6 billion. Here's a breakdown of the $1.6 billion. Almost $1 billion of deferred tax assets. This will help lower their taxes in the future. $240 million operating lease right of use assets. These are assets they lease from another company. And then other $409 million. So the total assets, $9 billion. 6 months ago, it was closer to $10 billion. Total liabilities, $8.1 billion. $550 million of accounts payable. This is how much money they owe when they buy on credit. $1 billion of accrued expenses. Here's a breakdown of the accrued expenses. Accrued compensation, $420 million. Warranty liabilities, $18 million. Operating lease liabilities, $41 million. And other, $487 million. The current portion of long-term debt, $749 million. Here's a breakdown of long-term debt. $750 million of notes due in 2025 at a 2% interest rate. $550 million due in 2027, $700 million due in 2030. So the total value is $2 billion. $749 million is due within 12 months. $1.2 billion is due beyond 12 months. So the $1.2 billion is down here in the non-current section. $2 billion of unearned revenue. This is when they receive cash for product or service before it's provided. So they have almost the same amount in the long-term section. We'll see the 2055 in the non-current section on their balance sheet. Deferred product revenue represents unrecognized revenue related to undelivered product commitments and other product deliveries that have not met all revenue recognition criteria. Deferred services revenue represents customer payments made in advance for services, which includes software and hardware support contracts, certain public cloud services, and other services. Finance unearned services revenue represents undelivered services for which cash has been received under certain third-party financing agreements. So they actually receive the cash before they sell the product. So they cannot recognize the revenue until they provide the product or service. Assets minus liabilities equals equity, $892 million of equity. They raised $947 million from selling their business, and their retained earnings are flat. I've never seen zero retained earnings. It's usually positive or negative, not zero. Their retained earnings as of 4/26 was $208 million. They had $547 million of net income for the quarter. They bought back $672 million of common stock, and they paid $83 million of dividends. So now it's zero. Let's look at the statement of cash flows. This is for the trailing 6 months. Operating cash of $446 million, which is down from last year, $588 million. It looks like the big difference was inventory. Last year they had a cash inflow of $46 million. This year they have a cash outflow of $130 million. All the other numbers look fairly similar. Well, accrued expenses, they had a cash inflow of $48 million. This year a cash outflow of $84 million. In their investing section, they spent $86 million on PP&E. Last year, $73 million. This page talks a little more about their statement of cash flows. They mention inventory. As I mentioned, inventory increased by $132 million, primarily due to higher raw materials purchases. The last section on the statement of cash flows is the financing section. They bought back $700 million of common stock, same as last year. They paid down $400 million of debt, and they paid $213 million of dividends. Let's look at the stock on Simply Wall Street. Its last price, $117, $24 billion market cap, flat in the past week, up 38% in the past year. It looks like they started trading in 1996. And if you adjust for stock splits, it was $1.80 a share. Remember the dot-com crash? Right before the crash, people were making money hand over fist. And this stock managed to stay in business. A lot of stocks went out of business. So from the bottom, it looks like the bottom was $1.55 to the top. It's close to like 90x. Fast forward 24 years, the stock is almost at its all-time high again. So if you picked up this stock after the dot-com crash, you could be really wealthy. But if you picked up a company like Amazon right after the crash in 2001 or 2002, that went up a lot more than this. But this went up quite a bit. Here's Amazon. Amazon IPO'd about a year after NetApp. It's hard to tell on this chart, but after the dot-com crash, the stock did go down like 80 or 90%. So it looks like in 1999, it got to over $5. Of course, the stock split adjusted. And then by 2002, it got down to 7.5 cents. You can't really tell on this chart because it's so close to the line. But even putting $1,000 into the company after the crash, you'd have many millions. With NetApp putting $1,000, you would have done well. You would have had probably $50K or something, or $100K, but you wouldn't have been a multimillionaire. Simply Wall Street's valuation is $199. They say the stock is 41% undervalued. 17 analysts priced this stock at $139. They also say it's undervalued. Here's their debt since 2014. It was $1 billion. Its highest was 2017, $3 billion. Then it got cut in half, came back up. Now it's at $2 billion. And their equity was higher than their debt. Now their equity is lower than their debt. Equity $900 million, debt $2 billion. So their debt is 220% of their equity. They do have more cash than debt, $3 billion of cash. So they're in really good shape. Their dividend yield in 2015 was 1.7%. Its highest ever was 2020, 4.5%. Because when the stock price goes down, the yield goes up. And the forecast for 2027 is 2%. They consistently pay a dividend, and every few years they raise it. It was 16.5 cents in 2015. By 2018, it was 40 cents, and currently it's 52 cents. The CEO's salary is about $1 million. Total compensation, $18 million. Tenure as CEO, 10 years. In the past year, one insider sell, no buys. 94% of the company is owned by institutions and 5% by the general public. Their biggest shareholder is Vanguard at 13%, then BlackRock. Geode at 3%, Goldman Sachs at 1%, and to round out the list, AQR Capital, 0.75%. And their employee count was 12,500 in 2014, now it's 11,800. And the ticker trades on Deutsche Börse, London Stock Exchange, Nasdaq, Mexican Bolsa, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.